My goodness, I'm Jack today. What's happening, everybody? I am joined by my colleagues, Julie Snow in the background. We got all things sales, Mr. Quinn, anything and everything you wanted to know about enrolling in the course. So more importantly, putting together deals at your firm, your university, and my mentor, Megan. Yes, she was my college professor way back in the day in the
Don't believe any words he says.
in the late 80s. She was my college professor, so she's my mentor. But before we get started, I just want to give my friend Quinn here a second to talk about a couple things. Quinn, take it away.
Hey, thank you, everybody that's joined. Thank you so much for the opportunity to, on behalf of Peter, Roger, the entire UWorld team, share with you a little bit about the insights about leases today. Just want to make sure that you're familiar with UWorld.
Where UWorld, Quinn? This is look at my shirt. UWorld.
UWorld. Sorry, little technical glitch on my end. Very weird. UWorld CPA review. So some of you may have heard of Roger. That's where we started over 5 years ago. And this last year, a dynamite acquisitions, bringing over the Wiley efficient team and program, increasing our portfolio significant and double down on CPA review. And Peter, so Peter, here, take it away. You'll hear from me at the end, guys, when we talk about how our methodology can support a success rate of a historic pass rate of 94%. So we're here to help you. Glad that you're here. Look forward to talking to you at the end.
All right, so folks, it's gonna way it's gonna work behind the scenes. We encourage questions. So really our goal today is to earn your business. People ask why we do these for free, because passing or not passing the exam could obviously change the trajectory of the rest of your professional life for sure. And chances are, if you like what you do for a living, you're a happier person. So that'll make you a better partner. So it'll affect your personal life as well. So we want to illustrate two things for you. Number one, how we walk you through the course materials. We do not sit there and read PowerPoints. Would not want to do that to you. All right. So we're going to show you how we actively walk you through and teach you the content. I got a lot of people all over the place. I have people in college. I got people who haven't seen leases in a long time. So we record our videos with the presumption of no prior knowledge, okay? So we walk you through that. It's a back and forth approach. And then we have these live online webinars similar to what we're doing today, part of the course, where we actually do problem solving. So then I'm going to show you on those classes, like what it is that we do in the live online sessions for the webinars. The reason why those are live online, because we want you to have the opportunity real time to interact with myself and instructors that are in the background. Today we got Megan handling everything in the background. Megan, you want to give a quick hello to the group?
Hi, happy to answer questions. Keep them coming. We're starting early this morning, but I love it. We'll get them answered. And, you know, if I don't know the answer, we'll save it for Pete.
There you go. And if I don't know the answer, I'll make it up.
Love it.
I'm only serious. I'm only serious. Okay, so this is what our notes look like. Want to point out a couple things. You know, again, no presumption of prior knowledge. We do want to emphasize, we took the position that this is a FAR free webinar. So we're going to focus in on leases from the perspective of the lessee, but anyone who's going to be taking BAR, just as an FYI, while the focus is on the lessor, you still have to know the accounting from the perspective of the lessee. So it's really 2 for 1, folks. So either side, you could take advantage of this. And by the way, there's a high predictive value of your performance in BAR, depending upon how you do in BAR. So when you're choosing your disciplines, FAR is a good indicator of what you're likely to, how you're likely to do on the BAR exam. We start every class with what's called the blueprints. We get this directly from the AI CPA, so there's no guesswork. What is it exactly they expect you to know? So number one, we'll talk about classifying a lease arrangement. Somebody asked about residual value. Is it guaranteed or not? We'll talk about guaranteed residual value. Hey, maybe there's a purchase option. Maybe there are some variable lease payments, etc. We'll be hitting the highlights here today. Most of what we're going to be doing, though, is calculating the liability, the asset, and then doing our journal entries. We're going to record lease expense or interest expense, etc. We also remind you in every lecture we do and every question we solve, there are basically 4 different types of skill levels that they test, right? There's remembering and understanding, knowing certain definitions. Hey, what's the criteria for classifying a lease as financing versus operating? Memorization, right? And then there's analysis, being able to apply it. It's kind of a higher skill level, more difficult multiple choice or maybe task-based simulation. And then you got your whole other ball game when you get to audit evaluation, right? Do you agree or disagree with the assertions of management? But we always want you to see what type of question you're likely to get. So the first thing I'm going to do is there's two types of leases, and I'm going to teach you how to memorize the difference between the two. First of all, big picture, contract law. Well, a lease is in fact a contract, a legally enforceable agreement. The key is it conveys, notice we didn't say the word possession. We said the word control, because if you delay getting in there, that's your business. You want to make improvements to the place, that's your business. But the lease payments are going to be spread over from the period that lessee gets control. Whether you physically have possession or not, or are actively using it, that's up to you. So you're going to see how that's different from possession in just a little bit. We'll talk about what exactly control is and how you determine that in a question. So key is control. How do we know if there's control? Well, do you, the lessee, have substantially all, what are the magic words we'd be looking for in multiple choice? The economic benefits from that asset. Do you have the right to direct its use? You may decide not to use it yourself. You may sublet it out if allowed in the contract. Or you may decide, hey, you know what? No, it's not a good time to open a store. I'll keep it vacant. That's up to you. But nonetheless, you got control. So guess what? You're going to be recording some rent expense, okay? So when you get control, that's the period we're going to start the rent expense, not when you necessarily start using it or occupying it. We always want to keep our party straight. So again, we're focusing in on from the perspective of the lessee. So our lessee, the renter, has the right to use it. The key is, though, they got to make the rental payments. And we are not cash basis. We will not be recording rent expense when the cash payments are made. So we are accrual basis, not cash basis. So be very careful. People are still tempted. They see the rent getting paid. They're thinking they're going to be recording rent expense. No way. All righty. So here's your first acronym. You ready? I'm going to call it a special kind of snob. If you're a special, I got my own language here, by the way. A special kind of snob, you're going to book it as a financing lease. What does the S stand for? Well, it's a specialized piece of property, okay? So there's basically no alternative use for the lessor at the end of the lease. Specialized. You meet that criteria, we're going to make that a financing lease. The S stands for the 75% test. Is the term of the lease greater than or equal to 75% of the term? It doesn't even have to be exactly that. They've kind of modified the rules, but for purposes of the exam, that'll be a good indicator. Maybe we don't meet that. Is the present value of the lease obligation greater than or equal to 90% of the fair market value? That's what the N stands for, the 90% test. Or maybe at the end of the lease, you get ownership. What's a synonym for ownership? Title. All right, you get title. So there's our O. And then lastly, maybe the lessee has been given a bargain purchase option. A bargain purchase option, folks. And what makes it a quote unquote bargain? Your opportunity to buy this at the end of the lease is so inexpensive, there's no way you wouldn't be buying this. So the car is going to be worth $18,000. They're giving you the right to buy it for 10, for almost a 50% discount. So folks, on the exam, as soon as you see criteria, what are you thinking? Am I a special kind of snob? Because if you're a special kind of snob, we're going to book it as what? A financing lease, a financing lease. If you do not meet any one of those criteria, you don't need to meet them all. Any one of those special kind of snob, 1 out of 5. Any one, financing lease. Otherwise, what's it going to be? An operating lease. All right, so to keep our classes interesting, we learn a rule, we apply the rule. That's the back and forth approach. We learn it, we practice it together, then you're going to do multiple choice questions after that subtopic practicing, and then you come back. It's a back and forth approach to keep you engaged. By the way, our lectures are such that we are very confident we will not be putting you to sleep. You ain't gonna have any problems hanging out with us and learning lectures. So the key is, while they're recorded in subtopics, manageable bite-sized lectures, because we want to keep it a back and forth approach, watching and working questions. We would love for you, though, to try to block out 4-hour blocks of time periodically to practice, watch the lecture, practice. Why is that? Because every part of the exam is 4 hours, and you know it's a mental marathon. You can't afford to get anything wrong exam day because you're mentally fatigued. God forbid you fail with a 73 or 74 and you made silly mistakes towards the end of the exam because you lost focus. So we're going to be building up that endurance together. Notice when I read this question, this would be a multiple choice, remembering and understanding. I don't start with the facts because I have no idea what to do with all those facts. I read the question stem first. Hey, is this an operating or a financing lease? So if I'm taking the exam, what do? Is it a special kind of SNOB? And then I'm thinking, term greater than or equal to 75%. Present value of lease obligation greater than or equal to 90% of the fair market value. At the end, do I get ownership? Do I get title? Or does the lessee have a bargain? Yeah, you could buy this thing at a discounted price, a bargain purchase option. You're a special kind of SNOB. So let's see, we take it one at a time. So here we go. Colton enters into a 20-year lease. There's the term. The lease is estimated to have a 30-year economic life. Right, stop right there. Now we're going to do the S test. 20 divided by 30, 2/3. 67% is less than 75. So I'm thinking, no, we didn't meet that test. Nope. The title does not transfer. Ownership doesn't transfer. Colton is not offered a purchase option. There's no bargain purchase option. The present value of the lease payments is $450, fair value $600. $450 divided by 600, that's approximately 75%. That's less than 90. And look at how they're messing you with the 75. The 75 applies to the term, not the present value of the lease obligation. So we didn't make the end test either. So then I'm thinking, is it specially manufactured for this lessee such that it has no alternative use to the lessor? I don't see it. So you know what, folks? It's not a financing lease. It's an operating lease. Now I'm going to plant the seed. You ready? If I'm taking the exam and this is a TBS, I'm immediately thinking, what are the consequences of this being an operating lease? We do not record. Do not record interest expense or amortization expense. We're not going to record that. Instead, we're going to record straight line lease expense. And I'll show you the journal entries and all that good stuff in a second. But you see, you take control of the exam. When you start with the question stem, you set it up, you feel confident, you check them off one at a time. You're not rereading, right? Once you go through it, you check it off, and then you're thinking, okay, what's the consequence of being an operating lease? But we'll get there in greater detail. So no, we do not meet any of this special kind of SNOB. So what kind of lease is it? An operating lease. Whoop, there it is. All right. Financing lease. You ready? When it's a financing lease, you meet any one of the 5 criteria. That's special kind of SNOB. The more times you write it, you hear it, you read it, you'll remember it. All right. It's kind of like you bought that thing. It's kind of like you own it. If you're not a special kind of SNOB, then what is it? An operating lease, more like a rental agreement. But key point, folks, I do not. Now, people who've been out of school for a while, the lease rules have changed since you were in school 10 years ago. I don't care if it's an operating lease or a financing lease. Initially, you are going to record the right of use asset as if you bought it, and you are going to credit that lease liability as if you bought it with borrowed funds. Exactly the same. They're both financing lease and operating lease. It's on the balance sheet, period. All righty. So that's a change for anybody who's been out of school a long time. So I'm going to show you how we calculate the right of the use asset and how we calculate the lease liability. Usually the same, but they don't have to be. Coming attractions. Okay, the lease term. That's the period of time. Who's going to have it? The lessee. Reasonably expect them to have it. So it's the commencement date plus Yeah, so we start here, the initial lease term. But is there a renewal option that's likely to be exercised by the lessee? If so, add it. Is there an option to terminate that is unlikely to be exercised? If that option to terminate is unlikely to be exercised, well, then add that time in. And if there's a renewal option, but it's controlled by the lessor, we are going to presume they renew. So we'll add that time in as well. So that's kind of multiple choice, so part of a task-based simulation. So moral to the story, no, it is not only the initial lease term. There are other factors we have to consider. No memorize. You don't have to write an essay on this. It's about recognizing, no, it's not just the initial lease term. All righty. Next thing is, this is what we covered. As a general rule, it's greater than 12 months. It'll either be an operating lease or a financing lease, depending upon whether it's a special SNOB. That's what we just learned. But on the exam, there's an exception to that general rule when it's a really short-term lease, really short-term. You could treat it as an operating lease, which you're going to learn how to do, or you can simply recognize rent expense each period. No asset or liability. So as a general rule, we recognize asset and liability. Operating lease, financing lease, we got to record present value of the lease obligation as a liability, etc. But do we always record an asset and a liability? General rule is we do. Major exception, super short-term lease, 6, 7, 8, 9 months. It'll be less than 12. You could book it as an operating lease and thus book an asset and liability and do all your operating lease accounting, or simply record rent expense only, no asset or liability recorded, okay? So be careful. Words like all, always, never, must, or only, great way to make a seemingly correct choice incorrect because the word is too extreme. All righty, we're gonna make a flashcard together now. You ready? What you write, you will remember. Now I know you're like, Pete, right? People haven't been writing since like the Stone Age, right? With the chisel on the wall. I know you think I'm old and all that stuff. I know Gen Z, you like to type, but I want you to Google for me. There's an article. There is empirical evidence that supports writing does more to create memory than typing. So I'm still a fan of old school, putting the pen to the paper because it helps you better remember the rules as opposed to typing. I kid you not, Google it. The article between typing and writing, what's better for memorization. But nonetheless, we see you are not a special SNOB. All right, so I read the question on the exam. I recognize, no, I am not a special SNOB. So step number 1, what are we going to do? Debit the right of use asset. Credit the lease obligation, the lease liability. All righty, now, are those two amounts always the same? Usually, but I'll show you later on how it could be different. And if they're different, the plug figure, if these are not the same amounts, they are not the same amounts, your plug figure to make your journal entry balance is going to be to cash or a payable, as I'll show you. All right, but that's step number 1. All right, when I see operating lease, what do I think? Do not record interest expense or amortization expense. Do not record interest or amortization expense. What are we going to record instead? Lease expense. Straight line. I'll show you exactly how to do that in just a little bit. All righty. Then you are going to credit the lease liability for what they call the accreted interest. This is going to make your lease liability go up. You're going to take the beginning carrying value of the liability for that period, multiply it by the interest rates. Just watch the number of months in the period. All right. We'll talk about that in a little bit. You will then credit your right of use asset to make your journal entry balance. That's how you're going to make it balance, by crediting the right of use asset. We are implicitly writing it off over time, spreading the cost of that asset over the periods benefited. Okay. Step number 3, we are then going to debit lease obligation upon making payment. Debit your lease obligation, credit your cash whenever you make that payment. That is your actual payment, but notice that is not my expense. That is not my expense. All righty. Now, statement of cash flow. Where's that lease payment gonna go? Where's that lease payment gonna go? That lease obligation when you reduce a financing liability. I just gave it away. Financing outflow. That'll be a financing outflow. Okay. I'll show you what happens when it's a financing lease late, financing lease later. So look, put the pen to the paper, man. You see these questions, you're gonna be banging them out, no problem. Let's keep rocking and rolling, baby. You ready? Look what we do again, application. Hey, this lends itself well to multiple choice, but it could be a task-based simulation. So we are putting you on notice, man. You better know how to do this stuff. Best way to practice and master the concept, a series of multiple choice. Once you feel like you have the concept mastered, then you could do your deep dive into your TBS, okay? You want carrying amounts? T accounts are my friend. I love T accounts, no memorizing formulas. All righty. We'll calculate our lease costs. You'll see how that's gonna work. All right, so our initial entry, you ready? I'm debiting my asset, crediting my liability. As a general rule for the same amount, I'll show if they're not the same amount what we do. All right, but as a general rule of thumb, those will be for the same amount. We are doing this for an operating lease and a financing lease. Step one is the same as a general rule, unless it's a super short lease of less than 12 months, then you don't have to record the asset and liability. All righty, folks, I need the present value of those lease payments. You ready? What am I looking for? Number one, the rate implicit in the lease. I need a discount rate to record an obligation at a present value. I want to discount it back to today, but at what interest rate? If they don't give you the rate implicit in the lease, then what do we look for next? The incremental borrowing rate. But that is secondary. That's if and only if the rate implicit in the lease is not known. This is primary. This is primary. This is what we look for first, because sometimes they give you both. Then the incremental borrowing rate would be distractor information. All right, what happens if the payment comes at the beginning of the year? Sometimes they'll use the verbiage starting today, immediately. First payment happens now, payment at the beginning of the year. Then I'm looking for the present value factor of an annuity due for N number of periods. Tell me the number of payments we're going to be making. So that'll be N. And then tell me what's the rate, the lease rate. And if they don't give me the rate implicit in the lease, then what am I going to use? Incremental borrowing rate. What if the payment comes at the end of each year? Well, if the payment comes at the end of the year, that's called the present value factor of an ordinary annuity, multiple payments of the same amount. N, the number of payments, and again, I, the rate implicit in the lease. If that's not given, the lessee's incremental borrowing rate. By the way, sometimes they like to mess with you. It's a payment that starts today, beginning of the year, but oh no, they don't give me the present value factor of an annuity due. So let me just say, let me pretend for a second. Let's say N is 5 years. So it comes at the beginning of each year. So I'm looking for the present value factor of an annuity due for N years, 5. And let's say the lease rate, for argument's sake, is 10%. But present value factor of annuity due, the present value factor of an annuity due is not given. What do? You panic. No, you would only panic if you took that other course. What's that course name? Wrecker? That they wreck your score, man. You don't take that wrecker. If they don't give you the present value factor of an annuity due for N periods, what are you going to do? Then find the present value factor of an ordinary annuity for N minus 1 periods. In my example, 5 minus 1, find the present value factor for an ordinary annuity for 4 periods. Take that factor, whatever it is, and then add 1 to it, and whoop, you got the present value factor of an annuity due. We're preparing you. No matter what they throw at you exam day, you're going to laugh in their face and say, this is embarrassing me. Why didn't you make the exam more challenging? This is ridiculous. You're insulting my intelligence. That's right. You'll mail in that letter. All righty. Now, I'm a big fan of step by step by step. All right. So this is step number 1. We record the asset and the liability, right? No big deal. This is the one journal entry approach. I'm not a fan of the one journal entry approach. Why not? Because it's overwhelming for me. I got a very small brain, as Megan will tell you. So I like to break it into its pieces, one step at a time. So I like the two journal entry approach. Same result, different format. So what am I going to do? I'm going to debit my lease expense, straight line. I'm going to credit my lease liability. And how am I going to calculate that amount? Beginning carrying value of the liability times my interest rate. And then I'm going to credit my right of use asset. That's my plug figure. That's journal entry 1 of 2. Then when I get around to paying, I'll debit my lease liability. I'll credit cash for my actual payment. I like to do it in 2 steps, logically, one by one. That's it, man. You see operating lease, you know what to do. So there's nothing wrong with the one journal entry approach, but my brain is too small for that. Break it down for me step by step by step, because that helps me to understand it rather than start memorizing, okay? I want to understand what's happening. This increase to the liability, anytime a liability is on the books at a discounted amount, you discounted it at a particular interest rate that represents future interest expense, accreted interest. As we record that interest, the liability gets pulled up towards face value. So that's all that is. The right of use asset, we got to write it off little by little over time, but we're not recording amortization. It's a plug figure. Okay, so we're going to spread out that cost over the periods benefited. When I make the payment, debit the liability, credit the cash. All righty, time is flying. Lease expense, you ready? With an operating lease, how do we do it? Straight line. Straight line. Find for me the total lease payments. Add it all up. Add it all up. And divide by your lease term, and you're going to have the straight line lease expense every period over the life of the lease. Every period over lease term. And when does it start? It starts when you get what? Not possession, not using it, but you have the right to use it. Whether you want to take 6 months and build it out and make improvements, or you just delay getting in there, you're booking that lease expense. Exact same amount every single month or every single year over the lease term, period. All righty. Now, we are going to be calculating accreted interest expense. We are going to be calculating it, but not recording interest expense. We take the lease liability times the rate times the time period. That's a credit to your lease liability. And then my right of use asset, that is a plug figure, just like I showed you. And we're going to do another example in a second. Okay, remember I was saying earlier the right of use asset and the lease obligation are generally the same, but they don't have to be. You see, here's the present value of the lease obligation, the present value of the payments, okay? So that we're going to learn how to calculate. That's generally the same amount that's used to debit the right of use asset, but not always, because sometimes we have some indirect costs we got to add in, like commissions, certain legal fees, executing the lease. You got a lawyer to oversee it. All righty, that'll increase the asset. That cost gets capitalized. Prepaid lease payments, we're not cash basis, we're accrual basis. That gets capitalized, added to the asset value. And then any lease incentives that, hey, when you sign the lease today, we'll help you pay your legal fees and some of those commissions. We'll give you a signing bonus, okay? That will reduce. Notice, key point, reduce, do not add. That reduces the asset, all righty? So it is possible that the right of use asset, when you debit the right of use asset, that might be for a different amount. Let's say I'll make up numbers, 55. But then we credit the lease obligation. When we calculated the present value of the lease obligation, the present value of the lease obligation, that was only 50. What the hell do? We don't panic. We're not taking record. What do? We credit cash, because that cash probably represents maybe some prepaid or maybe some legal fees or commissions. Generally the same, but not always the same. All right. So what do we do with these other costs? we capitalize and amortize over the term of the lease. Why do we do that? Because it's the matching principle. We're going to record these expenses over the period in which it helps to generate revenue in the period incurred rather than when the bill is paid. All right, so we're going to see how that's going to work. Initially, lease liability, the present value of the lease obligation. Read for me carefully. Is it coming at the end of each period, or is it coming at the beginning of each period? Present value factor of an annuity due, or present value factor of an ordinary annuity, and you know how to take that and adjust to annuity due if we had to, okay? Plus the present value of any guaranteed salvage value, plus the present value of any guaranteed salvage value. That usually comes at the end of the lease. So let's say the lease term, for argument's sake, is 10 years. Let's say the rate is 12%. I want the present value factor for a payment coming in 10 years at a rate of 12%, but it's the present value of one. It's a one-time payment on the back end. So you'll add up the present value. You're going to first want to calculate the present value of the lease obligation, the periodic payments, that's an annuity, and then separately calculate the present value of the guaranteed salvage value, add it together, and there's the present value of the lease obligation, okay? So initially recorded at the present value of the lease payments. Each period, we're going to do two things with an operating lease. We're going to calculate the accreted, I can't spell accreted, and I was going to ask Quinn, how scary is that? You got to calculate the accreted interest. That's going to make your liability go up. And then when you make your payment, that'll make your liability go down. Journal entry 1 of 2, journal entry 2 of 2. At the end of the lease, what's the lease liability going to be? 0. All right, we love to give you summary slides. So the right of use asset, the lease liability are usually recorded at the same amount. Okay, but not always. If there's any prepaid rent, that is an asset. That'll make the right of use asset go up. A refundable security deposit. Refundable, you're going to debit. Long-term receivable, you're going to credit. Refundable, credit cash. Sometimes that long-term receivable is called a refundable deposit. Sometimes they actually call it a refundable advance or a refundable deposit. It's a long-term receivable, okay? So that's a separate asset. You make improvements, you will capitalize and amortize. You make improvements, you start, putting up nice chandeliers and, doing all kinds of stuff. You will capitalize that, and then you will amortize it over the shorter of remaining lease term or the useful life of those improvements, okay? With an operating lease, what do we record? Lease expense, no interest, no amortization, just rent expense. And how are we going to do this? Uniformly, the exact same amount. And when does it start? When the lessee gets what? Not possession, not when they start using it, but when they get what? Control. Bang, baby. So those are the rules, okay? No presumption of prior knowledge. Now it's all about practicing. We practice together, then you would stop. Work a series of multiple choice on your own, practicing the operating lease, getting good with that, then you come back and then watch the financing lease. That's the back and forth approach. And it's great because it keeps you engaged. It sucks to sit through 3-4 hours of somebody droning on without any practice in them. It's like, where the hell am I? You don't even know where to begin. Doesn't happen here. It's a back and forth approach. And notice, I'm not reading PowerPoints. We don't read, we teach. There's a big difference between reading and teaching. It's why I left where I was. I ain't reading nothing. I can't teach math by reading it to somebody. Put the pen to the paper and show me real time how to do it. And talk to me about what you're thinking as you do it. That's how I learned it. That's how I learned from my mentor, Megan, who's the best in the business. PhD, as smart as can be, but humble. Just a nice person. You'd want to hang out with her, have a cup of coffee. Isn't that right, Megan?
Absolutely. Right? I don't even make you call me doctor.
Doctor. Give me the news, I gotta.
You don't want to hear me sing.
No. All right, here we go. January 1, a company enters into what? An operating lease. As soon as I see operating lease, what am I thinking? No interest expense, no amortization. What are we going to record? Straight line rent expense. When does it start? As soon as you get what? Control. All right. So for an office space, and there's the magic word, when do they receive control? They enter into on January 1 and get control of the property, and they're going to make leasehold improvements. When does the rent expense start? January 1. Now, the company begins making alterations to the property March 1, distractor information, although we will capitalize and amortize those leasehold improvements over the shorter of useful life or the term of the lease, but I will capitalize and amortize. Staff moves into the property May 1, good for them, distractor information. Monthly rental payments begin on July 1. I could care less. Rent expense starts January 1. Payments are going to begin when? July 1. When we start making payments, we'll record that month's rent expense for the January 1 through July 1, where we were booking the expense but crediting. So from January 1 through July 1, and we'll do it at the end of each month. From January, how many days in January? I have no idea, but at the end of January for 6 months.
31.
31. From January 31 to how many days in June? June 30, right? For those 6 months, we're going to be debiting rent expense for the straight line amount, crediting rent payable. Starting on July 1, what are we going to do? Debit that rent payable, debit the rent expense, straight line, credit your cash payment, which you're going to know this amount. The rent expense, you're going to know that amount. So the rent payable is going to be what? The difference, your plug figure to make your journal entry balance. And there you go. So while you're not going to start making payments till July 1, we are not cash basis. It is accrual basis. All righty. But we will nonetheless be recording rent expense 6 months, January 1 through June 30, even though we're not making a payment. And that's it. And we're kicking ass. So January, we get control. Rent expense starts. Rent expense starts even though there's no payment and we're not even using the property yet. We begin improvements. You will capitalize and amortize those costs. You will not expense them in the period that you spend the money. Staff move into the office. Total distractor information, could care less about that date. July 1, that's when the lease payments begin, and then you'll start doing your journal entries as I showed you. So we know that all this other crap means nothing. All right, we're going to recognize the expense as soon as what? We control. When do we get control? January. So January 31st again, we will debit our rent expense. We will credit our rent payable. Okay, and we're going to do that every month through June 30th, those 6 months. Then on July 1, what are we going to do again? Debit July 1 rent expense, same amount, straight line, same number that we booked in January. It'll be the exact same amount. We will then debit rent payable, get rid of that. That'll be our plug figure. And then what do we credit? Cash, whatever our payment is. All righty. And where does that go, that cash payment? That's a what? Operating outflow. Under an operating lease, that'll be an operating outflow. I'll talk more about that later. Okay, so that rent expense, that'll be an operating outflow. All right, let's take a look at an example. You can handle this, you got it. So let's do it. You ready? Mitten Company, they're smitten. 5-year rental, so N equals 5. No renewal option, stop right there. Are we a special kind of snob? I want to go through these one at a time. 75% test, 90, do I get ownership title, bargain purchase option? There's no renewal option. Okay, January 1, year 1. Economic useful life is 10 years. So 5 divided by 10. That's only 50%. We did not meet the S test, 75%. That is less than 75%. Incremental borrowing rate, I'm going to use it. If they don't give me the rate implicit in the lease, I'll use the 6. The payments are $10,000 per year, due when? At the end of each year. I need the present value factor for an ordinary annuity. As an inducement to enter into agreement, the client is offered the first 6 months free. Wait a second, what's the payment each year? $10,000 per year, first 6 months free. So that's $5,000 saving, okay? So 1/2 of the year, first 6 months, no payment. So $5,000 is saved. We don't have to make that payment. As an inducement to enter into the agreement, the client is offered the first 6 months free and a $1,000 signing bonus. What's that going to do? Make the right of use asset go in what direction? Up. Okay, the lessee has incurred $1,000 of initial indirect costs, legal fees, executing the lease, commissions. That's going to make the right of use asset go up. Oh, and I'm sorry, the lease bonus is to us, the lessee. They're giving us the $1,000 to pay the initial direct cost. So that makes the asset go down, arrow in the wrong direction. Okay, let's see. The present value factor of a lump sum at 6% for 1 year. Okay, those are my present value factors. Let's see. Is there anything about the fair market value of the property? I don't know. If the present value of the lease obligation was greater than or equal to 90%, but they've given me no indication of what the fair market value is, so the rebuttable presumption is the end doesn't apply, and I see no bargain purchase option. Is it specially manufactured? Nope. So folks, it's an operating lease. They got to give you the fair market value for you to even consider booking this as a financing lease. They didn't give it to you. So the presumption is we don't meet that test. All right, now how do we deal with the $5,000 that's saved, that's free? That's going to reduce my obligation, right? That's a payment I don't have to make. So that reduces my liability. What I do have to though pay is $10,000 is my payment, and I'm got to make 5 payments. Okay, I need my present value factor for an ordinary annuity corresponding to the number of payments and a rate of 6%. So the present value factor of an ordinary annuity at 6% for 5 years is 4.212. So I take my $10,000 payment, I'm multiplying it by my present value factor of an ordinary annuity, 4.212, and I'm going to get $42,120. Now, what about the $5,000 I save? The present value of that savings, the present value of that free rent reduces your obligation. So the present value of the free rent reduces your liability. How much are we saving? $5,000 that we don't have to make. That's a one-time savings. That's one time in year 1. So I need the present value factor of a one-time savings in year 1. So what's the present value factor of a one-time savings in year 1 at an interest rate of 6%? 0.943. 5,000.943. This is a savings of $4,715. That is the present value of what I don't have to pay. So what is the present value of my lease obligation? $37,405. So that's my liability. Now, is my asset amount the same? There's a lot of stuff going on with the asset. So I'm not 100% sure yet that my debit to my right of use asset, I haven't calculated that, but I do know the present value of my lease obligation is $37,405. If this number is not the same, we'll debit or credit cash, all right, for any differential, because remember, they gave us $1,000. No, where was it? $1,000 signing bonus. So they gave us $1,000. All right, so I might be debiting cash, but then I had to use that cash to pay the lawyer and the commissions. Let's see how it works out. So they tell me, All right, we do not meet any of the special SNOBs, so we know it's an operating lease. No interest expense, no amortization expense. What are we thinking? Straight line expense. Straight line. So let's do the straight line. You ready? Year 1, 5,000. Year 2, 10. Year 3, 10. Year 4, 10. Year 5, 10. What's the total amount? $45,000. My total payments, $45,000. What's the term of my lease? Term of my lease, 5 years. What am I going to be recording? $9,000 of lease expense, starting when we get what? Control. Absent any other information, when do we sign the lease? January 1. When do we have the right to use the property, make improvements, or do nothing with it? January 1. So rent expense, lease expense starts year 1. We're not going to do it month by month. We're just going to do it year by year. And again, since it's straight line every year for the next 5 years, regardless of the payment we make, we'll be debiting lease expense, okay, for $9,000. All righty. Now, let's see. Here we go. Now, there's 2 ways of calculating the present value of that lease obligation. Let me show you. This is method number 2. I'm not a fan of this method, but I'll show it to you just in case you've been taught it this way in school. It works. We've got 5 payments, right? We've got 5 payments. We got the present value factor for an ordinary annuity for 5 payments at a rate of 6%. So some people say, okay, take the $42,120, okay, but payment number 1 really doesn't count because not all 5 payments are at $10,000. That's the present value factor of an ordinary annuity, okay, if all payments were $10,000, but the first payment's not $10,000. So some people like to do this. I don't. It's an extra step. But they say, okay, let's take payment number 1 that's not $10,000, and let's find the present value and deduct it because we don't actually have a $10,000 payment in year 1. So they come up with $32,690. But what they do have is a $5,000 payment in year 1. So what's the present value of the $5,000 payment year 1? $4,715. They then add those 2 together and get the $37,405. I'm not a fan of that because there's too many calculations for me. There's 3 instead of 2. You see the way I did it, we said, okay, I've got 5 payments, $10,000, 4.212, $42,120. But then I'm getting free rent of $5,000, one-time savings, a one-time savings. So I take that 5,000 and I multiply it by the present value factor of 1. One-time savings coming at the end of year 1 at a rate of 6%. And I say, okay, that 5,000 times that 0.943, that's going to save me $4,715. Thus, same result, different format. Folks, that's just what makes more sense to me. But look, it's shown in textbooks, different ways. As long as you're getting it right, then that's it. So you have an option, whatever you're most comfortable with, okay? So let's now take a look at the right of use asset. You ready? The right of use asset generally equals the present value of the lease obligation. This is the right of use asset that may or may not equal the present value of the lease obligation of $37,405. For simplicity, here's the present value of the lease obligation. Lease payments made at or before the commencement date, we don't have any of those. Okay, lease incentives we have, they gave us a $1,000 signing bonus, but then we had initial indirect costs, commissions, legal fees. So you add 1,000, subtract 1,000, coincidentally, we're right back to $37,405. If they were not the same, the plug figure would be to cash. Either debit cash, you got more than you paid out in fees, the bonus exceeds the fees. So debit right of use asset, credit present value of that lease obligation, $37,405. If it turns out the bonus, let's say it was $1,200, greater than your cost of $1,000, then we would have a $200 debit to cash. Conversely, if the bonus were only $700, less than the cost of $1,000, then we would have a credit to cash for $300 to make our journal entry balance. That's all, okay? We'll see more of that as we move along. So whether it's a financing lease or operating lease, step one is the same. We got to record the asset, we got to record the liability, period, end of story. All righty. Now, you see this? Overwhelming. Nah, I ain't reading that to you. You'd want to slap me if I read that to you, and rightfully so. So what we're going to do instead, I'm going to put a nice blank slide here. You ready? Step by step by step. Here we go. Payment number one, end of year one. What's my journal entry? You ready? One of two. I like to do them one at a time. I'm going to debit my lease expense. What was that straight line amount? $9,000. Total payments were $45,000. We got a term of 5 years, $9,000 per year. Debit my lease expense. Okay, my lease liability. I take the beginning carrying value of my liability, $37,405. Multiply it by my interest rate, 6%. Lease liability, accreted interest, $2,244. What's my plug figure to? Right of use asset. That is my plug figure to make my journal entry balance, 9,000 minus 2,244. My credit to my right of use asset, 6,756. Now keep your T accounts. For your liability, we started at 37,405. We just increased it by 2,244. Just increased it. All righty. Journal entry 2 of 2. I now make my payment. What's my payment? I debit my lease liability. I credit my payment. But in year one, it was only $5,000. So I'm reducing my liability by $5,000. End of year one, $34,649. That is at the end of year one. That is my lease liability. My asset was at $37,405. We just reduced it by $6,756. So at the end of year one, what's my asset? $30,649. Year one is complete. They're not going to ask you to go out more than 2 years. Okay. Payment number 2, end of year one. You ready? Excuse me, end of year 2. Payment number 2, end of year 2. Payment comes at the end of each year. What do I debit again? Lease expense, $9,000. Credit lease liability. Now, the beginning carrying value of the liability is now how much? End of year one, beginning of year two, $34,649. $34,649 times my rate, 6%. So that works out to be $2,079. Right of use asset, that is my plug figure. So difference between 9,000 and 2,079. How much am I going to credit my right of use asset for? 6,921. So my liability started at 34,649. We just added 2,079. Journal entry number 2 of 2. I debit my lease liability. But my second payment is for how much? Now I start cranking out payments of how much? Payment number 2, $10,000. $10,000. So now my liability is going to go down by 10,000. What's my lease liability? End of year 2, 26,728. What about my asset? My asset was at 30,649. We just reduced it. My plug figure, 6,921, 23,728. You know what's screaming? Task-based simulation. Look at how easy that is, but it lends itself well to a task-based simulation.
Hey, Peter, there's a request to go over your special kind of SNOB mnemonic again. We missed
Special kind of SNOB. You got it. You ready? To determine whether or not it's a financing lease, you need to meet any one of 5 tests. Special, is it specially manufactured such that it has no use to this lessor? I mean, the only one who's going to use it is this lessee. That's it. Then it's a financing lease. Or the S, is the term of the lease pretty long, like greater than 75% or more of the asset's useful life? If it's a long-term lease, greater than 75% of the term, you met the S test, you would call it a financing lease. The N is the present value of the lease obligation, in this case, $37,405. Is that greater than or equal to 90% of the fair market value? What if the fair market value was $50,000? What's 90% of $50,000? 45. Is 37 greater than 45? No, we don't meet the N test. Do you get title, ownership at the end of the lease? It would be a financing lease. Nope. The B, do you have the right to buy this asset at a bargain per, like if you ever lease a car, they say, when you bring this car back, it better have a value of $12,000. And they say, well, listen, you know what we'll let you do? When you bring the car back, we'll give you an option to buy it, but not at 12. We'll let you buy it at 5. That's a bargain. Who the hell's not going to buy a $12,000 car for $5,000? They give you a bargain purchase option, makes it a financing lease. You meet any one of those 5 tests, it's financing. If the answer to all 5 of that is no, then it's an operating lease. When I see operating lease, do not record amortization, do not record interest expense. What do we record? We record straight line lease expense. And notice, my lease expense and my payment, not the same, not the same. Lease expense is going to be exactly the same every year, but it is unlikely to equal the actual cash payment. That's it. All righty. So here's now that pretty little chart, starting with the right of, and did I skip one? I think I did. Yeah, let's do the lease liability schedules. Do these numbers look familiar? But like, this is overwhelming to me. It implies and screams memorization to me. It's not understanding, but it might work for you. I don't care, whatever works for you. But we started with 37,405. Okay, we increased it by the accreted interest. We reduced it by the payment that year, giving us an ending balance of 34,649. The interest that we recorded that year made the liability go up, but then the payment we made the liability go down. So the net change to the liability, 7,921. What's the liability amount? 26,728. Same result, different format. I just like the T accounts one step at a time because I'm not going to be doing a full-blown amortization schedule, but I understand it now, you know, and you will. You'll be able to fill out an amortization schedule, no problem. Okay, right of use asset. Ready? We started with an asset of what amount? 37,405, which may or may not equal the lease obligation. Why did we reduce that by 6,756? Well, let's see. That was our plug figure in our journal entry, right? In year 1, that was our plug figure. The difference between the lease expense and the accreted interest, that's where we got the 6,756, 30,649. In the next year, our lease expense, okay, that got recorded straight line. Notice the same amount every year. We calculate the interest expense. That makes the liability go up. The difference between the straight line lease expense and the increase, that's our plug figure. Reduces our asset, 23,728. Where are we? 23,729. We'll split the difference on the dollar. And there it is. It's about understanding, not memorizing. All righty, so here's all our pretty journal entries. I just wanted to show you. You could do it. Journal entry, you could just do it as one journal entry. All we did was break this into two. Lease expense, $9,000. Credit the lease liability for the interest, $2,244. And then our right of use asset, that was our plug figure. That was our plug figure. Then I debited the lease liability for the $5,000 payment, credited cash, $5,000. Combine it, there's one journal entry. Okay. Whatever floats your boat, folks. I'd like to do it step by step. Journal entry year 2, cutting to the chase. I debited my lease expense also for $9,000. I credited my lease liability for the year 2 interest, beginning carrying value, $2,079. My right of use asset was my plug figure to make it balance, $6,921, the difference between the $2,079 and $9. And then I debited my lease liability, credit cash for my actual payment, $10,000. $10,000. So we made the liability go down, up and then down. What's the net change to the liability? That's the net change to the liability. The interest made it go up by $2,079. The payment made it go down by $10,000. The difference between those two is $7,921. For some reason, my little pea brain likes to do it step by step. It just helps me to understand it. Notice the amount paid in year 1 is different from the amounts paid in subsequent years. Keep track of the actual cash payments, but the lease expense, that's the same, because that in fact is straight line, folks. So that in fact is straight line, so that's the same. All right. So each year the lease payment does not equal the lease expense. They're different. Now, is it ever possible for them to be the same? You don't have to memorize this. But if every year the amount paid, $10,000 per year for 5 years, $50,000 divided by the 5 years, then what would be my straight line lease expense? $10,000. What would my payment be every year? $10,000. So it's usually different, not always different. It's usually different, right? We stay away from all, always, never, must, only. All right, so if this was our actual course, folks, this would have been broken into 2 separate lectures for you to practice. This would be another breaking point where I'd say, okay, guys, go get yourself a cup of coffee, Red Bull, whatever it is, go work the questions on operating leases, and then come back, and then we'll talk about financing leases. That's where our course works. So this is an illustration of how the course works. I'm going to go through financing leases with you. Now, if you don't mind, and I'm so sorry to my UWorld friends, if you got to go, you got to go. I know this is scheduled to 1. Financing leases is going to take me to 1, but I promise I want to show them at least a couple of what our live online 2 to 3 hour actual problem solving looks like. So it's not, oh, no, we're not reading the same damn PowerPoints. It's not a regurgitation of the same damn thing you watched in the video. It's different questions. We choose hard questions, so please bear with me. We'll probably be done closer to 1:30, okay? So I am saying about 1:30, but I got a 20% standard deviation, so I'm thinking about plus or minus 15 minutes on either side. Very unlikely to be in the left tail, more likely to be in the right tail. Sound good? Sounds good. You need a break?
Yeah,
hell
maybe
no.
we work overtime today.
Overtime, baby, overtime, overtime. Megan, any questions for me before I move on to financing leases?
I mean, I'm just interrupting you with them as we go.
Oh, sweet. All right, you keep doing that. I like being interrupted. All right, so here we go, folks. You ready? So let's see accounting again, but now it's a financing lease. How do we know it's a financing lease? You meet any one of special SNOB, 75% or longer, present value of the lease obligation greater than 90%. You get ownership title, or you got a bargain purchase option, or you're the only one you could use it, less or don't want it back. Any one, not all of them, any one of the 5, it's a financing lease. Step number 1, what are we still going to debit? Right of use asset. What are we going to credit? Lease obligation for the present value of the payments. These amounts are usually the same. Should they not be the same? If not equal, What's going to be our plug figure to make our journal entry balance? Cash. Either you'll debit cash. Why would you debit cash? Because the bonus you got is greater than your cost. Why might you credit cash? Because any bonus you got is less than your cost for the legal fees and the commissions. That's all. Ain't no biggie. All right. Now, make what you write, you will remember. Everybody writing? Typing is cool. Writing is better. Writing is better. Old school. But I thank God I'm not making you do the old hammer and chisel. Now, Megan, back in the day when she took the CPA, it was not computer based. They didn't have computers. It wasn't even pen and paper. Megan had the old like chisel and hammer back in the cave. All right, so cash payment, you ready? You're going to take that cash payment, whatever that is, and I need you to separate it out for me. You ready? You're going to take the beginning carrying value of that liability times the rate. You are actually going to debit interest expense. You're going to debit interest expense. Okay. You're going to take that payment, whatever it is, minus what you just recorded for interest expense, minus what you just recorded for interest expense, you're going to debit lease liability. That's going to be the reduction of the principal. You're going to credit cash for whatever your payment is. Now, interest expense, that portion of the cash payment is operating outflow. The lease liability reduction is financing outflow. With an operating lease, the total lease payment is an operating outflow on the statement of cash flow. When it's a financing lease, the portion of this payment that is for interest operating, the portion that's for principal reduction, that's financing outflow. Okay, step 3, you're going to take that right of use asset. You're going to divide it by the number of periods, and you're going to debit amortization expense, credit your right of use asset. Now, what the hell do I mean by the number of periods? Tell me what test you met. Specialized SNOB. If you meet the 75% test or the 90% test, the number of periods is the shorter of the useful life or the term of the lease. If you meet the O, the B, or it's special, you're going to use the useful life. So the number of periods, what test did you meet? And this supersedes the O, the B. If you meet both the S and the O, you go with the O. You meet the N or the O or the B, you go with the O and the B. All right, because basically you own it, it's yours. So then so it makes sense, doesn't it? You're never giving it back. Either you got title, it's yours forever, depreciate over to useful life. You got a bargain purchase option, you're buying it, useful life. Special, the lessor don't want this thing back. They got no use for it. It's yours, useful life. Okay, if you meet the 75% or the 90% test, the math test, then it's the shorter of useful life or term. But there it is, man. That's what it is. All right, so let's try an example here. All right, let's try an example. Oh, and I skipped. You know what? Let's go right to the examples. You got a feel for the rules. I would walk you through all the rules. I think we're good with that. Let's just go right to the examples. You ready? Sound good? So you're
Hey, quick question for you though. We have one question that says that somebody who's been using sample questions, that are out there online, whatever, and you get marked wrong if you use an account twice in one journal entry. So if you have lease liability debited in one line and credited in another line, you would then need to net them. Having both of them.
Yep, the TBS dictates whether you have to combine 2 journal entries into one. All right, so the way the TBS, and that's an awesome question, the way the TBS is set up, sometimes like it's pro forma, like let me show you this. You ready? Like it might be pro forma, like one big ass journal entry. That's cool. It's pro forma that way. You got to fill in like this, right, guys? You see pro forma, but that doesn't stop me. That doesn't stop me from when I'm doing my setup to say, oh yeah, what's the first thing I got to do? I got to debit that interest expense. I got to debit the lease liability for the principal. Okay, I could still do it in two. Credit my cash payment. Then I got to debit my amortization expense. I got to credit my right of use asset. All you got to do is one at a time. That's it. Okay, so here you could just combine this all into one. For the operating lease, lease expense, credit your lease liability, credit your right of use asset. Then debit your lease liability, credit your cash payment. With the operating lease, you just got to net these two out. That's all. Okay, because when it's set up in a TBS, it'll be pro forma. The net reduction to the account is what you got to use. That's just net it out. But awesome, awesome question. Whoever answered that, when you pass this exam, 2 coffees for you and a cheese doodle. Love that question. Brilliant. You see, this is why we do this live, because you got some super smart people out there that have been practicing questions from all kinds of test banks. They bring value. It's awesome. Who asked that question, Megan? Can I embarrass them?
You know, Michael asked that question.
Michael, I love you, man. You're all right, Michael. Smart man. Michael, I foresee a 98 in your future. All right, here we go. So here's our examples. You ready? Where do I start? Question stem. I have no idea what to do with all these facts. All right, first of all, we're going to classify this as an operating or a financing lease. So what's the very first thing I want to do? Special SNOB, one at a time. All right, so now, same fact pattern as before with mitten. Now assume, however, that the economic useful life of the equipment is 5 years rather than 10. So it's not 10. The useful life is 5. We signed a 5-year lease. 5 divided by 5, that's 100%. That is greater than 75%, folks. We just met the 75% test. Let me just see if we meet any other tests. Incremental borrowing rate, I'm scanning. Inducement, client's been offered physics of okay. The lease $1,000 indirect cost, present value factor, ordinary annuity. Okay, so we met the end test. All righty, so what are we gonna do? It's a financing lease. Soon as I see it's a financing lease, what am I thinking? I'm gonna debit interest expense. I'm gonna debit that lease obligation, that lease liability for the principal reduction, credit cash payment. I'll debit my amortization expense, credit my right of use asset. All right, because I met the S test. Remember, if you meet the S or the N, shorter of useful life or term. O or B, useful life or it's special. You meet any of the math tests, shorter of. All righty, so we've got a term of 5 years. The client, let's see, so it begins control. This is when we start recording our expense year 1. Now notice, January 1 to December 31st, 12 months of interest. Now that hasn't been a factor yet, but I want to put that on your radar. Sometimes you sign the lease February 1 or October 1. You would not record a year's worth of interest or a year's worth of lease expense if it was an operating lease, right? Be mindful of the dates. It hasn't applied here. We're, teaching other things, but just like everything else, depreciation, be mindful of that. Okay, payments are due when? At the end of each year. So what am I looking for? Present value factor of an ordinary annuity corresponding to 5 years and a rate of 6%. As an inducement, we've been offered the first 6 months free. So the present value of that one-time free rent, that's going to make my liability go down. We got a $1,000 signing bonus, right of use asset, down. $1,000 in indirect costs, right of use asset, up. Present value factor, 6%, 0.943. Ordinary annuity, 4.212. All right, so again, I'm going to do it the way that makes sense to me. So 5 payments, $10,000 times 4.212, 42,120. But year one, there's a one-time discount of $5,000. What is the present value of that one-time discount off the rent? The one-time discount is $5,000. Present value factor of a one-time discount at the end of year one. The discount's coming in year one. If the discount were coming in year two, then I would need the present value of 1, n equal to 2. If the discount was coming at year 5, present value of 1, n equal to 5 years from now. But I only got to discount this back 1 year. So 5,000 times 0.943. This is off the rent. So that got me, let's see, 4,715. 37,405. That is the present value of my lease obligation. Now, what about my right of use asset? Not sure yet. So now let's do our right of use asset. Okay, so we met the 75% test. You meet the math test, shorter of economic life, the useful life, or the term of the asset, financing lease. Okay. Operating lease or financing lease, doesn't matter, same, but not always. Just be careful of a really, really short term, less than a year, then you don't have to book the asset and liability and you could just record rent expense. But January 1, year one, right of use asset, credit your lease liability, okay? Let's see. Now, each period, what are we gonna record? Amortization expense. So the S or the N, shorter, O or B or special, useful life. We met the S test, so it's going to be the shorter of the useful life, 5 years, or the term of the lease, 5, well, they're one and the same. Okay, they're one and the same. So we'll take our 37,405, divided by 5 years, 7,481. Okay, so that is straight line, no change, all 5 years. All righty, now I'm going to debit my interest expense for how much? Beginning carrying value of that liability, 37,405, times 6%. Now, I know this seems silly, folks, but please highlight in your notes. You don't always sign a lease on January 1. Here, it's January 1 to December 31st, so it's all 12 months. 2,244. Debit my lease liability. Well, that's my plug figure, the principal reduction. Credit cash, year one. What's that payment? $5,000. So the plug figure, 5,000 minus 2244, 2756. So my liability was 37,405, just reduced it by 2756. So what is it now? 34,649. That's the end of year one, beginning of year two. Journal entry 1 of 2, journal entry 2 of 2, amortization expense, 7,481. Credit your right of use asset or accumulated amortization, whatever they give you. Okay, then you combine this. If you have to combine it, that's cool. Check them off one at a time. Find that debit, find that debit, find your 2 credits, and you're good to go. Put your debits in first, then your credits, and you're good to go. All righty, so that's it. Again, your amortization schedule makes it look harder than it is. It's not that hard, folks. How do we do year 2? Well, year 2, end of year 1, beginning of year 2, multiply it by, get your interest expense. We debit our interest expense, end of year 2, 2,079. My lease liability, that's my plug figure, credit cash, but now we're crediting cash for what amount? 10,000. So this is 10,000 minus the 2,079, that's 7,921. Debit my amortization expense, no change, 7,481. Credit my right of use asset, 7,481. No change, no change. And that's it. Keep track of your assets and your liabilities. All right, so if we had the asset T account, the asset T account started with 37,405, right? So my asset, sorry about that, folks. My asset started, what am I doing? I'm going in the wrong direction or the right direction? Wrong direction. So my asset started with 37,405, same as my liability, right? We reduced it by how much? 7,481. That's the year one. Then we reduced it a second time by what amount? 7,481. All right, so at any point in time, you take your 37,405. Let's say you want the asset value at the end of year two. You take the 7,481 times 2, subtract that, and there's your balance after 2 periods of amortization. I mean, it's, just like depreciation at that point. Here's one journal entry, no problem. We can combine it if we have to. We can do it in 2. We can combine it into 1. Whatever you want to do. Here it's in 2 journal entries, but they could have set this up. 1 of 2, 2 of 2. So look, TBS, how is it set up? That's why, folks, when we do TBSs together, legalize cheating. What I always start with, my requirements and what my answer choices look like. That'll dictate to me whether I need to combine it or I can do it separate, right? So legalize cheating, we learn how to do that as well. Year 2, same thing. Been through all these numbers, piece of cake, piece of cake, piece of cake. Let's try another one. You ready? New set of facts. Here we go. And then we're going to work some problems like we would on our weeknight problem solving classes. You ready? Step number 1, start with your question stem. First of all, is it operating or a financing lease? So what am I thinking? Is it a special kind of SNOB? We signed an 8-year lease. There's my term, 8, with payments of $75,000 per year. Do what? Beginning of the year. Love it. Present value factor, annuity due, baby. The estimated economic life of the equipment is 10 years. 8 divided by 10, hey, that's 80%. We just met the 75% test. It's a financing lease. As soon as I see it's a financing lease, what am I thinking? Interest, amortization, blah, 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 blah. Okay, depreciation method, they're going to use straight line. There's no residual value. Title to the equipment. What? Title passes. Oh, look at how they threw that in. So not only am I meeting the S, I'm meeting the O. That supersedes anything. So what am I using? Useful life. When I calculate my amortization, useful life. All right. Lessee's incremental borrowing rate is 12, but the lessor has made it known that the lessee, that the rate implicit in the lease is 11. The 12 is what? Distractor. What did we learn earlier today? What is primary? The rate implicit in the lease. If that's not given, then we have no choice but to use the lessee's incremental borrowing rate. All righty. So now I'm looking for, what are my present value factors? Now look, they're not given here. I'm going beyond the scope of this example, so I want to teach you something here, okay? So I don't want to just do, we know it's not operating, we know it's financing lease. You ready? Present value factor for an annuity due. How many payments do we have? I have 8 payments. So N equal to 8, and what rate am I going to use? 11%. You know what that present value factor is? It's 5.7122. But what if that is not given? What the hell do? We say, thank God we took UWorld, because UWorld's got me covered. Then I would look for the present value factor of an ordinary annuity, but not for 8 periods, 8 minus 1 for 7 periods at that same rate of 11%. That present value factor of that ordinary annuity would be 4.7122. I would add 1 to it, and whoom, there it is. There's your present value factor of an annuity due. I would take my 75,000, multiply it by 5.7122, and I would get present value of my lease obligation, 428,415. 428,415. I would debit my right of use asset, 428,415. I would credit my lease, 428,415. Okay, over what period of time are we going to record this obligation? And you know what? I'm going to add a slide here. Oh, didn't want to do that. Sorry, folks. Insert. Let me just get a new slide. I want to keep it as neat as I can. You ready? So I'm going to debit right of use asset, 428,415. 415, which was the 75,000, times that present value factor of an annuity due, 5.7122, credit my lease, 428, 415. What date did we sign this lease? January 1. Now, folks, it's a present value factor of an annuity due. You know what that tells me? First payment now. So what else am I going to do? I'm going to make that first payment, right? So I'm going to debit on January 1, lease obligation, 75,000, credit cash, 75,000, and that's all principal reduction. Okay, so while my lease started with on January 1, 428, 415, I just reduced it by 75,000. So on January 1, what's my lease obligation? 353, 415 after I make that first payment. Excuse me. And I'm going to take that right of use asset, 428, 415, and I'm going to divide it by what? Useful life. What was the useful life, did we say? We said the useful life here, let's see, was how much? Title passes. So the useful life was 10 years. So I'm not using the term, I'm using the 10 years. So 428 divided by 415, straight line amortization. Straight line amortization, 42,842, and that would be recorded at the end of year 1. Just watch your dates though. Watch those dates. January 1 to December 31st, we would record all 12 months because when did we get control? January 1. Okay, January 1. All righty, so keep rocking and rolling, baby. Let's keep rocking and rolling. So again, we get ownership. We got title transferred. So that means 42,415 divided by useful life, 10 years, not 8, the term. Okay, anytime you get ownership, you meet the O, the B, or the special. All right, the O, the B. Now, at December 31st, and I'm going to make this neat, so I'm going to insert. I'm so good at this. Look at that. Whoop, there it is. You ready? December 31st, year 1. What are my journal entries? December 31st, year 1. You ready? I'm going to debit interest expense, but for how much? I started with 428. My liability started at 428. 415, but we reduced it by 75,000. So what do we have in there? 353, 415. Now watch your dates carefully. Interest expense, 353, 415, not 428 times 11%. The rate implicit in the lease, 38,876. And then folks, what do I have to credit? Interest payable. Why? What the hell happened? Why interest payable? Payments made January 1. So you're not making a payment here. So 38,876. Okay, that's journal entry 1 of 2 at December 31st. Journal entry 2 of 2, debit amortization expense, 42,842. Credit your right of use asset, 42,842. That was the 428, 415 right of use asset divided by, again, useful life, not the term, 10 years. That's where we got those numbers. Then January 1, year 2, that's when we make our payment. All righty, so I'm going to debit interest payable. I'm going to get rid of that interest payable, 38,876. I'm going to credit my cash for $75,000. And then what's my plug figure to? My lease liability, my principal reduction. That is my plug figure. 75,000 minus 38,876. I am going to debit. I'm just going to move this over so we can clearly distinguish debits from credits. So my interest payable, 38,876. I will reduce my obligation by 36,124. Credit cash, $75,000. Okay, my liability just went down by $75,000. So 353, 415, 353, excuse me, my lease liability just went down by 36,124. Payment number one was all principal because it happened on the first day. Payment number two was the 36,124. So that gets me 384,790. That's my liability beginning of year two. Okay, so there it is, beginning of year two. Got it? I mean, so, you know, you got to watch the dates of your payments and all that kind of stuff. All right, so let's see, anything else I want to cover here? We got all that. And then, you know, your second year, you would repeat this. Okay, want to do a second year here? We could do a second year if you'd like, but I don't think we can move on to questions now. I think you got it. Let's see, did I want to do a second year? Yeah, what the hell? Ready? So December 31, year two, debit interest expense. Now my interest expense, 384,790. 384,790 times 11%. So 384,790. Let's see. Just make sure I'm getting the right numbers here. 353, 415. Let me check my math. Minus 36,124. I think my number is wrong. That doesn't make sense. Hold on. Let me check my numbers. Sometimes you got to check your numbers. 353, 415 minus 36,124. That is 317,291. 317,291. Okay. The other number was the right of use asset, the 428, 415 minus the 42. So the 428, 415, if we had an asset T account. So if we do our asset T account, we started with 428, 415. We reduced it by 42, 842. So 428. Can't read my own handwriting. 428, 415 minus 42, 842 minus 385, 573. So at 385, 573, there's your asset value after year one. Okay, so year two, our interest expense, 353, 415. Excuse me, 317, 291. Come on, man. 317, 291. So 317, 291. So we had 428, reduced it by 75, 353, 14, reduced that by 36, 124, 317, 921. So 317, 921 times our 11%, that would get us 34,902. Credit interest payable, because we do not actually pay that until January 1, 34,902. We would debit amortization expense for the exact same amount. Credit right of use asset, and short-term memory is not so good. What would he say that was? 42,842. And then January 1, year two, debit our interest payable. $34,902. Reduce our lease obligation, our lease liability. That's our plug figure. Credit cash, 75,000. And the 75,000 minus 34,902, that would be $40,098. $40,098. So our liability T account is now going from 317 to 91. We just reduced it by another 40,098. So now it is at 277,193, 277,193, and so on and so on and so on. Okay, so that corresponds to our amortization schedule. Okay, so right of use asset equals that. Lease liability, credit cash, first payment, annuity due starting now. Same date, same date. You got to remember, and this is all principal reduction. So make that T account 428, 415. Immediately subtract that 75,000, 353, 415 is where we are now. Okay, amortization per year, straight line. Remember, we're using useful life because we met the O or the B or it's special. Here's our amortization schedule for our liability. This happened January 1, right back to that January 1. This reduction happens January 1, year 2, when the payment is made. So then there's our balance again, January 1, year 2, after the payment has been made. Okay, here's our year 2 payment, and so on and so on. Okay, so that takes us all the way through. Amortization expense, right of use asset, no change, all years. So you can find your any missing balances. Okay, so whatever that is, so all these numbers we've seen. Okay. So last issue before we try some questions. If it turns out that there's a difference between the debit to your right of use asset versus the lease obligation, because remember, the lease obligation is solely the present value of those payments, and that includes guaranteed salvage value, which I didn't have an example here, but somebody asked about it earlier. So that includes the present value of any guaranteed salvage value. Okay, any difference is going to go where? To cash. So let's see what that might look like. So let's take a look at an example. For example, what if the present value of the lease payments is $561,800, but then we have initial direct costs of $5,000. So your commissions, look for legal fees and executing the lease. Your right of use asset is going to be greater than the lease liability due to those costs. Now, this will either be a cash or an account payable if you owe the money. Okay, but there's your plug figure. If they don't equal, there's your plug figure piece of cake. All right. We always love to end with a summary slide, operating lease versus a special kind of SNOB, financing lease. This is to be understood, not memorized, okay? So it's a great way to conceptualize and review after the fact. So now what you would do, if this were the course, you'd stop and say, okay, now I want to apply this to a series of questions. You would do that on your own. And then you might struggle a little bit. The beauty is sometime that week, we will have a live online class. It's usually 7 or 8 Eastern time. I'm in New York, so it's Eastern time, 7 or 8 o'clock at night. It's usually 2 to 3 hours. You have the opportunity to interact with us live, okay? Myself, Megan, and others, but beyond that, it's then recorded for you. If you say, Pete, I'm in a different time zone, that don't work for me, or I'm working late, or I got an event, no worries. It's recorded for you, and then it's available on demand. So you will see in the software, there's going to be a tab called Events. This will be one of the events. In addition, if you're a current UWorld student and you're like, wow, Pete, I heard you were doing a free class just on leases, always register for those other events. even though we make those available to the general public, I have a lot of current students right now that, good review on Leases. They could join us anyway. And by the way, when you register for our free events, you get an email with the archived, recorded on demand of things you missed. Like I think I did bonds, I think I did cash flows. And then in a little while, I'll be doing consolidations, I think in September. So if you're struggling with consolidations, it's always heavy hitting topics. We can't do the whole course for free because otherwise I'd be out of a job. My kids would be hungry and I'd be very thin, which I'm not. Actually, it might not be a bad thing if we didn't get paid for a while, but nonetheless, this is what we do. So we're looking to earn your business, but I want to show you now what the live online segment looks like. Okay, so I'm going to switch gears. I'll come back here in just a second. I'm going to switch gears. I want to go what that looks like. Okay, now I just want to show you in that deep dive, that deep dive, we don't just do one topic. Like we might do a series, accounts payable. We're going to do investments. We did notes and bonds payable, discount, interest paying, non-interest paying, accounting for income taxes. That makes for a good free lecture. I think you all should petition for that, right? I think that'd be pretty darn cool. Let's see. And then let's see accounting. So this is a sample of what would happen in the live online. It's not just regurgitating the same crap, same questions that you saw in the lecture. It'd be an incredible waste of your time. So here we go. Any questions for me, Megan, before I jump into this?
So quickly, somebody wants to know on amortization there, are we using useful life? Are we using—
Come on, man. Who's not freaking paying attention? Who is not paying attention? Darn it. If you meet the math test, the S or the N, shorter of useful life or term. If you meet the O, you get ownership, title, bargain, purchase, option, or special. You own that thing. You're going to have it its entire useful life. What do you use? Useful life. And if you meet some of these and some of these, what supersedes everything? The special OB or the SOB, whatever you prefer. Now, whoever wasn't paying attention and asked that question, I hope you have a pencil nearby. What I need you to do is sharpen that pencil really to a nice sharp point. Then I want you to take that pencil and as hard as you can, right your leg. You see what happens? The damn phone is a distraction. Look at how hard it is. All we've been here is less than 2 hours and 45 minutes and how hard it is to concentrate. Something like that could cost you 1 point, which could be the difference between a 74 and a 75. We cannot, should not, and will not let that happen. Right? Right, Megan?
I mean, I agree with you.
All right,
I
thanks.
agree. Somebody did ask, what's the difference between that with that name that we don't say versus UWorld? I mean, other than the fact that we have Peter Olinto, and that just makes us amazing.
Yeah, well, no. Let me tell you, my honest thing is that other course, they wreck everything. Listen to me, all seriousness. I made the jump for a reason, okay? They got purchased by private equity. We had a dispute on philosophical teaching. I'm a teacher, not a presenter. I'm not reading PowerPoints. I'm not going to have them pop up as they speak. It's not doing it because it's got to be real time, step by step by step. That's number one. Number two, I looked at the UWorld and I looked at this team that they were putting together. So the organic UWorld people like Amber, Megan, and others who are amazing. Roger's team, Roger's amazing, a formidable competitor, despite the fact he was one guy. Unbelievable. And then they bought Wiley and brought over that entire team, people who write some of the best-selling textbooks in the nation. That's the team I want to be a part of. In addition, there is no one at UWorld who is allowed to teach unless they were in public accounting, which means you can get the letters in some states and have never worked in accounting. I don't know how that happens, but it happens. I know for a fact there's people teaching tax who never did a tax return at a public accounting firm, never did it. Trying to teach audit. They never worked, they never did an audit. How the hell are you teaching something you've never done? I'm not a fan of that. UWorld cuts no corners. And let me tell you something, Roger's expensive. I'm kind of expensive myself. They want the best and they're going to pay for it. And every detailed explanatory answer, they don't cut corners. It's not about, hey, click back, link back to the text. No, every single answer choice has a detailed explanatory answer explaining why the right answer is right, the wrong answers are wrong, and a key takeaway. And then you can immediately make flashcards from that, second to none, every single question. So look, it's the team I wanted to be a part of. You know, many, many moons ago when I joined that other course, they were consolidating and buying all the talent in the industry. I said, man, that's the place to be. And I see those same stars aligning now. And look, UWorld's been the engine, man. You talk about, ask a doctor about UWorld. You ain't gonna find a doctor who didn't go through UWorld. Ask a lawyer what course they're taking. A high stakes bar exam is UWorld, and they're kicking everybody's ass. And I don't want to get my ass kicked. I want to be part of the ass kicking, not the ass getting kicked. I want to be the kicker, not the kicky. All right, you're like, shut up, stupid. Let's do an example. You ready? So, where are we going to start exam day? Question stem. I don't know what to do with those facts. December 31, year 3. What amount should the company report as the lease liability on that balance sheet? All right, let's see what we got. I see a lease question. So what's the first thing I'm thinking about? Is it an operating lease or a financing lease? Right up there, they tell me operating lease. I'm taking the exam. I see operating lease. What am I thinking? No interest expense. No amortization expense, not recording that. What am I recording? Straight line lease expense. Why is it an operating lease? I am not a special SNOB. Now, when we review these questions in the live online, answering these questions, ironically, is incidental in the process. I want to use the questions to review the rule in its entirety. So they tell me, term of the lease is 5 years, so N is equal to 5. The company took possession and began to use the building January 1, year 1. Okay, all things being equal, that's controlled. The annual rent is $24,000 due when? On the first day of each year. What do I need? First day, present value, factor, annuity due. Assuming an implicit rate in the lease of 6, I don't need the incremental borrowing rate. So now I need present value factor, annuity due, corresponding to 6%, 5 periods. Okay, they tell me the present value of the lease payments at the inception, they gave me 107, 163, cool. So they gave that to me. So step number 1, while they didn't ask for it, what are we gonna debit? Right of use asset, 107, 163. I am gonna credit lease liability, my lease obligation, 107, 163. But the first payment becomes due when? Immediately. Okay, becomes due immediately. All right. So, you ready? I got $24,000 payment, straight line, number of payments, 5. What's the total amount? $120,000. What's the term? 5-year term. So what is that? 24,000 lease expense per year. 24,000 lease expense per year. All righty. Now, my first payment was made immediately. Again, I'm a fan, you know it, T accounts, baby. I don't want to memorize anything. As soon as I start trying to memorize things, that's when I make silly mistakes. So, lease liability, 107, 163 on January 1. Immediately we made a payment, January 1 as well, $24,000. So where am I now? 83,163, 83,163. That's January 1, year 1. All righty. Now they don't ask for journal entries, but I don't care what this question asks. The goal is to review the rule in its entirety. So that's what we're going to do. All righty. We've got to go all the way through to year 3. All right. So let's see what we got. And I'm just going to insert a slide here. So bear with me. We get a blank slide. Blank. There we go. Okay. So January 1, year 1. Debit lease liability. Credit cash. $24,000. All principal reduction. All principal reduction. So again, 107, 163 minus the 24,000, payment number 1. We are now at 83, 163, January 1 again. Okay, December 31, year one. Debiting my lease expense. Now remember, I do it in two and then you can combine it. Debit my lease expense, straight line, $24,000. Credit my lease liability. Now for what amount? The accreted interest, 83,163 times the rate implicit in the lease, 6%, 4,990. Now that makes my liability go up. I'm just going to keep track. 83,163. I just made it go up by 4,990. Well, let me stick to what I said. Let me use my T account. Let me not change on you. Liability 107,163. Payment 24,000. We said 83,163. Okay, I just increased it by 4,990. 4,990. What's my plug figure? My plug figure, right of use asset. There is my plug figure. My plug figure, $19,010. 19,010. 24,000 minus the 4,990. All righty, so that's December 31, year one. All right, now January 1, year two is when I make the payment. January 1, year two is when I make the payment. I will debit my lease liability, $24,000. I'll credit cash, $24,000. Okay. $24,000. Payments made at the beginning of the year. All right, so I just made another payment, agreed? So 83,163, the 4,990, we just made a second payment, 24,000. Where are we now? Let's see, that is $88,153. Let's see, 83. So that is, I can't, come on, man, why can't I read my own handwriting? This ain't fair. 83,163. You're not the only one who can't read. 83,163, 4,990 plus 24,123 minus 64,153. 64,153. Beautiful. Okay, you ready? December 31, year two. Debit my lease expense, straight line. Debit my lease expense, straight line, $24,000. Credit my lease liability. My lease liability, take that 64,153, multiply it by that 6% rate. I'm trying to keep this neat. Sorry, guys, 6% rate. So let's see, that's 3,849. Credit my right of use asset. My right of use asset, my plug figure, 24,000 minus the 3,849. So that works out to be a credit to my right of use asset, 20,151. Let me just double check that. So 24,123, 3,849. Yep, 20,151. Okay, we don't make our payment until January 1 of year three. We'll make our payment. So we will debit our lease liability, 24,000, credit our cash, 24,000. So 64,153, it went up. So it went up by 3,849. You can combine the journal entries. 3,849 went down, $24,000. So where are we? $44,002. And that would be our balance before we do our accruals at the end of the year, $44,002. So where do we go? $44,002. Whoop, there it is. All righty. So again, while they don't ask for journal entries, it doesn't matter. Okay. What's the key takeaway in this? Operating lease again, no interest expense or amortization. Straight line lease expense. Why are we an operating lease? Because we are not a special kind of snob. So that's what we would be doing in the weeknight class. Let me show you another one. You ready? Let's take a look at another one. They tell us, let's see. Start with the question stem. What amount should the company record as a right of use asset? Okay, a company enters into all right, stop right there. It's an operating lease again. Okay, so we've got an operating lease. Do the same thing, no interest expense or amortization. I need straight line lease expense. Right of use asset, usually, but doesn't have to equal the present value of the lease obligation. There could be things that make the right of use asset go down, that give you money back, or goes up, commissions, legal fees. Okay, so it's more than just the present value of the lease obligation. Okay, the rent is due when? Last day of each year. Present value factor, ordinary annuity, $10,000. There's my payment. The company received half off the first year's rent. So that's a one-time discount. The present value of that one-time discount is going to make the present value of the lease obligation go down. Half of 10,000, that's $5,000. First year, what's the present value of that one-time payment? End of the year, 0.943. 5,000 times point. Oh, this looks familiar. 4,715. Outside of that, how many payments do we have? I have 5 payments. What rate do I have? The rate implicit in the lease, 6%. So the $10,000 payment times the present value factor of an ordinary annuity, 42,120. Now this is a rent off, so there's our 37,405. What do we debit? Right of use asset, 37,405. Credit lease obligation, 37,405. Okay, now, easy, we know that. But what are my total payments? One payment, 5,000. 4 payments at 10,000. 5,000, 40,000, 45,000. Total payments. Total payments, 45,000. What do we always divide that by? The term, not the shorter of the term, not the shorter of the term. Term of the lease, 5 years. What's my straight line lease expense? $9,000. Okay, $9,000. All righty. So most common mistake, 42,120, because that forgets that one-time discount reduces the present value of the lease obligation. That's illustrating setup, folks, setup. All right, more than anything. And now we actually gave you, now you know what they're going to do to you on the exam. They'll give you the present value factor of 5 periods from now, distractor. They'll also give you the present value factor of an annuity due. It's a distractor, because when is it coming? The last day. If you give it a present value factor of 1 for n equals to 5 periods, the discount's not coming 5 years from now. It's coming in year 1. We only have to discount it back 1 year. All right, because we love this stuff, let's do another one. Here we go. You ready? We'll answer the question, but then we're going to go beyond the scope. Start with the question stem. What should we report as amortization of the right of use asset, December 31, year 1? All right, ultimately we'll answer that, but let's see what we got. We leased equipment under a 4-year financing lease. So they told me I'm a special kind of snob. So as soon as I see financing lease, what am I thinking? I got to record interest expense. So I'm going to debit my interest expense. Beginning carrying value of the liability times my rate times my number of months over 12. Just be careful. Don't assume it's January 1, although it is. We're always prepared, though. I'm thinking, right? So I'm going to debit my interest expense. I'm going to debit my lease liability. That's my plug figure. I will credit cash my payment. All righty. Then I'm going to debit amortization expense, credit my right of use asset. More than happy to put it into one if they ask me to. Okay. So they tell me the present value of the lease payments is $348,680. We got a 5-year economic life and a $20,000 guaranteed residual value. The present value of the lease payments already includes the guaranteed salvage value. If they did not include it, you would take the present value of the payments plus the present value of a one-time guaranteed amount. So if they did not give it to you, I'd want the present value of one. What's the term of the lease? 4 years from now at whatever rate they give. By the way, they don't give a rate. Do me a favor. I'm giving you a rate. I am giving you the rate. Don't worry about how I calculated the rate, but that is the rate. I'm giving it to you. I want to work with that. All righty. So that's how you would find the present value of the guaranteed salvage value. All right. So when do the payments begin? Unless they tell you otherwise, what's always the presumption? When they don't say when the payments begin, when they don't tell you that, then what are you to assume? Ordinary annuity. That's the default rule. Okay, that is the default rule. Okay, so let's see. Special SNOB. All right, so what are we going to depreciate this over? 4 years or 5 years? When they tell me it's a financing lease, the equipment has a 5-year economic life. 4 divided by 5. 80%. We met the 75% test. I have no idea about the 90% test. The equipment reverts to the lessor, so we're not transferring ownership. And I don't see anything about a bargain purchase option. I don't see anything about a bargain purchase option. Okay, there's nothing about it being special. So I am going to take the $348,680, debit my right of use asset, $348,680, credit my lease obligation, $348,680. I'm going to take that right of use asset, $348,680, and I'm going to divide it over what? The shorter of the useful life, 5, or the term of the lease, 4. Term of the lease, 4 years. Okay. So divide that 348,680 divided by the 4, 87,170. 87,170. 87,170. Choice D, and there you go. Now I want to do something with this. I'm going to insert a slide. Again, the goal is to review the rule in its entirety. Insert new slide. I want a blank slide. There we go. You ready? So I want to play with this now. All righty. So term is 4 years. Okay. My rate, I said implicit in the lease, 12%. All righty. My payment, $114,797. I'm giving you that information, given information. All right. So I'm giving that to you. All right. So that would be times your present value factor, all that kind of good stuff. But now I'm just giving you this. Okay. 114,797. You ready? January 1. We debit the right of use asset, credit the lease for that, whatever it was, $348,680. Okay. Now, end of year 1. December 31st. Remember, this is a financing lease. So we got, what do we have to debit? Interest expense, $348,680. I made up an interest rate of 12%, $41,842. My lease obligation is going to be my plug figure. My plug figure. Credit cash, $114,797. I gave you that information. What's the difference? $72,995. That is one of two because we have 2 journal entries. Then debit our amortization expense, $87,170. Credit your right of use asset, $87,170. You want to combine it? Combine it. Okay. Remember, the key takeaway that this question was illustrating was what? What period? The shorter of, because the only thing we have objective evidence of is the term is 80%. We met that 75% test, the S test. You do the math, you use the shorter of, the useful life of the term, okay? And sometimes you'll see accumulated amortization. I've seen that in intermediate accounting or advanced accounting textbooks, so you could always see that as well. All righty, let's try one more, and then I will let you guys go to the library and review. You ready? Where are we starting? Question stem. December 31, year 2 payment. By what amount should we reduce that financing liability to? So when we make that year 2 payment, okay? So the year 2 payment. All right. They tell me December 31, year 1, we leased equipment. Now this is weird. The start date is December 31. That is weird. So the start of the lease is December 31, year 1 already. Something different. Annual lease payments, $40,000 due December 31. Present value factor annuity due. Although that's the end of the year, that's the same date the lease starts. So the first payment begins immediately. Present value factor of an annuity due. All right, what are my number of payments? 10. What is my payment amount? $40,000. Equipment has a useful life of 12 years. We've got a rate implicit in the lease, 10%. So I need my present value factor for an annuity due. Okay, my present value factor for an annuity due. Now they tell me the financing lease liability was recorded at $270,000 before the first payment. So we could back into, because we have no family, no friends, no pet, we could actually back into the present value factor of the annuity due. If you take the $40,000 payment and you multiply it by the present value factor of an annuity due corresponding to 10 years at a rate implicit of the lease at 10%, you get $270,000. Because we have no family, no friends, and you're going to put your dog to sleep because there's no time to walk it or feed it. If you have a goldfish, you're going to drown it because you can't feed it. It's 270 divided by 40,000. 6.75. There's your present value factor of an annuity due, taking the 270 divided by the 40. So that would be the present value factor of an annuity due corresponding to 10 years, interest rate of 10%. All righty, so first thing we would do, December 31, year 1, that's when we sign the lease. This is the beginning of the lease. Debit my right of use asset, $270,000. Credit my lease obligation, $270,000. It's a financing lease. I'm a special kind of snob. A special kind of snob. All righty. So that means I got to record interest expense and amortization. All righty. So I've got my liability, $270,000, December 31. I immediately make a payment of $40,000, right? 40, was it 40? Yes, it's 40. So that's $230,000 at December 31. Okay, what is my journal entry there on that very first payment? What is my journal entry on that? You ready? We're going to debit our lease obligation, $40,000. We are going to credit cash, $40,000. It's all principal reduction. So on the statement of cash flow, when you're reducing principal, financing outflow. If it's just lease expense, operating outflow. If it's a combination of interest and principal reduction, the interest portion, operating outflow, the principal reduction, financing outflow. All righty, so there's payment number 1. Payment number 2. Payment number 2, December 31, year 2. So I started out my liability, 270,000, reduced it by 40. So $230,000. December 31, year one. Now I've got to do my journal entry for December 31st, year two. You ready? So my second payment, I'm going to debit interest expense, $230,000 times the rate implicit in the lease, 10%, $23,000. Debit my lease liability, my principal reduction, my lease liability, my principal reduction, that's my plug figure. Credit cash for my $40,000 payment, 40,000 minus 23,000 to $17,000. I'm just going to move this over so the debits and the credits don't line up. Sorry about that, folks. Credit my cash, 40,000. So what's my reduction to my principal? $17,000. What else would I have to record? Amortization expense. Credit my right of use asset. What did my right of use asset start at? 270. What are we going to divide that by? Well, what did they give me? Well, let's see. The term of the lease was how long? 10. The total useful life is 12. What's 10 divided by 12? I'm pretty sure that's more than 75%, but let's check. 83%. We met the SNOB. We met the S test again. There's no indication about the 90, the getting title, bargain purchase option. There's no information about special. So what are we going to do? S or the N, the math, shorter of useful life 12 or term 10. So we're going to take that 270,000 right of use asset. We are going to divide that by 10 years. What is that? $27,000. Debit my amortization expense, $27,000. Credit my right of use asset, $27,000. Okay, my lease obligation just got reduced by how much? $17,000. So what's the balance after that payment? 230 minus the 17. We now have a balance of $213,000 at December 31, year two, and then we'll use this amount to calculate the interest expense in the next year. Okay, so again, just a little taste of what the course is like. So the goal again was to illustrate, what our notes look like. So I want to go back to that. This was an illustration of our live online classes. This is an illustration of our ebook and how we teach from the ebook. I want to open it up now.
You could go back to number 3. They wanted to just see quickly the answer on number 3 there.
I'm so sorry. I'm sorry about that. Oh, number 3?
Yeah, question number 3. If you could just go back to the correct answer there for D.
Yep, 87,000. Sorry about that. 87,170. So I'm just going to move that over. That was the right of use asset divided by the shorter of the useful life or the term. Why is that? Because the only test we met was the S test. So we use the shorter of the useful life or the term. If you meet the O or the B or the special, you use the useful life because basically you're getting that asset for its entire life. So 87,170. Let's see. So, woo, baby.
Also a question about exam strategy. Somebody wants to know how many minutes, seconds, etc. How much time should I spend per MCQ?
All righty. So you got to take your number of, so the first 2 testlets, right? 2 hours. 50% of the exam is multiple choice. 50% of your exam is task-based simulation. So the first 2 testlets, you got to be less than 2 hours. You're going to need a little bit more than 2 hours for your last 3 testlets, which are your task-based simulations. Off the top of my head, darn it, 25 questions per testlet. So that's 50 questions. So that is 120 over 50 to be exact. Am I right? 25 questions per testlet and FAR? I got to think.
Yep. Yeah, you got it.
Yeah, so that's 50 questions over 120 minutes, 2.4 minutes on average. All right, but look, there are questions that are not designed to be answered in 2.4 minutes, my friend, because there are going to be questions like, Cash collected from customers, operating, investing, or financing. You're going to get that right in 10 seconds because you're going to know it's operating and get it right quickly, giving you now an extra 2+ minutes for a more math intensive question. All righty. So while it's an average, be mindful. Sometimes math intensive questions longer, but that's balanced by the theory questions that are shorter. So within a testlet, I'll tell you what my strategy is. You know what I love to do? My first pass through that testlet, I'm getting all those quick ones out of the way. And if it's a question that's theory, you either know it and you get it right quickly, but shit, if you don't know it, get it wrong quickly, because you're gonna need those time in the more math intensive questions. First pass, you knock out all those easy ones, then you're gonna see, wow, you know, I have X number of questions. I got a lot of time left. Now if you did the average, you probably have like 4 minutes per question because you did all the easy ones first, right? You get those in the bank. Task-based simulations, 3 testlets. One of those testlets is gonna have 3 problems in it. It might be a lease. No, let's say it's a consolidations, a bond, and a lease. Let's say it's a bond, consolidation, and a lease. And you're like, wow, I missed Pete's class on bonds. Shit, I wish I had taken it, but I know consolidations and leases inside and out. Well, you know what you're gonna do? Even though the bond question was first, you're working that one last in that testlet. Because if you're gonna rush on a testlet, let's rush on a testlet on a question that you weren't gonna do all that well in anyway, right? You do your easiest ones first, your hardest ones last. A lot of this is built into the course, folks, too. We're constantly talking about that. All righty. Quinn, I'm sorry, Megan, any other questions before we go on to meeting our instructors here?
I mean, people just saying nice things about you, but we don't need, you know, you to get a big ego.
Now, first of all, do me a favor. In this crazy world today, you know what it is, folks. It's not the old days word of mouth. Now it's like on, whatever you call it, the ticking and talking and the Instagram and whatever the hell else is on there online. I would appreciate that, not only for myself, but for the course, for Megan. But really, these are some of the nicest people in the industry. I mean, you just want to do business with them. And Roger's like the funniest guy you will ever meet. You know what I love about Roger? He's so smart, but like Megan, is so humble. He doesn't shove it in your face. He doesn't talk like this and talk down to you. No, we have a good time with it. You know what? Because I'll tell you right now, if we had an IQ test for everyone on this call right now, I could guarantee you my IQ is in the left tail. Break it down for me step by step by step. You will never have me on step 3 because my mind don't work that way because I ain't that bright. But you know where my work ethic is? In the right tail. And that's why I kick ass on standard. I'm a professional test taker, man. And this is why I kick ass. And I will build your confidence, because at times you'll say, man, Pete sounds like a dumbass. And you're right. And so if I pass these exams, you should be getting a perfect freaking score, because you probably are much smarter than I am. All righty. What else we got? Any other questions, Megan?
I mean, like I said, just people, you know, saying nice things about you, and then some people asking, and Julie's responding right now to people, you know, asking about how they switch over to UWorld if they've already purchased other products. So,
all right, Julie, I love that. By the way, I want to show you guys something. I just want to show you. This is Megan, another humble person, PhD, CPA, public accounting experience. Amber, wonderful person, organic here at UWorld. Just everybody loves her. I mean, just look at these credentials. And you've got Puskar here. You want to talk about ISC, Information Systems and Compliance? Not some dude who read in a book, man. The dude, you know, this guy actually does it. Greg and Suzanne write one of the best-selling tax books in the U.S. You want to get taught by people who've actually done it, man, who know what you're going through in public accounting as well. This is the team you want to be. And I could go on and on about everybody here. Another unbelievable person, PhD, CPA, but sweetheart, nobody's going to intimidate you. They're doing you a disservice if they get up there and sound all smart. Please. Let's see.
Pete, somebody wants to know how you can be a CFA, a CPA, and a JD. Like, how did you pass all those tests and get all those courses?
Hard work. You know what? Anxiety. You know what drove me? Blue collar from the Bronx. You can tell my accent. I know you thought I was from Alabama. I'm not. Listen to me. My parents struggle week to week. My father broke down physically. I was not going to work a manual labor job. I can't even change a light bulb. All right. Desperation to not work a shitty job. Best motivator. I talk about money and opportunity. All true. Best motivator for me, working shit jobs where I was like, God forbid I was stuck in this job my whole freaking career. I had no connections. I wasn't no legacy at an Ivy League school. I was screwed unless I made it happen. So for me, and I also got a big mouth. I wasn't going to be a corporate kind of guy. Public accounting to partner. I don't play golf. Like, I don't got that skill set. Law firms, same thing. They do exact races.
I feel you.
I was at a law firm, opportunity internship, whatever the hell. I never do a sack races. I said, man, I'll never fit in here. I can't do a sides. And they were like, oh, you got a physical issue? I said, no, I got a mental issue. It ain't me. I don't have that. See, what drove me? I have to make these things happen for myself. Letters are no guarantee of success or happiness, but sure does increase the probability. All right. And what I actually found was I like taking the test more than anything because I was not. Ask my friends in high school. I wasn't the sharpest pencil in the box, but I found with hard work, perseverance, patience, and practice, not only could I do it, I could do really well. And then I found my passion in teaching. You know, I started teaching CPA and then went on to law school and I continued to teach, sat for the CFA, continued to teach, and I found my passion because I instilled confidence. Because you know, if I do it, you can do it too, and you will do it. Before we move on, representative tasks, and Quinn, I got this. Remember I was showing you earlier the skill levels? We never make it guesswork. You are gonna know what that topic is, how it's likely to be tested, because we spell out in our text exactly what the skill level is. We give you the topic weight so you can see the forest through the trees and the way our textbook is set up. And I'm sorry, Quinn, for stealing your thunder. Look at this. Representative task. Oh, this is application. Representative task. Oh, this is analysis. We are screaming to you. Hey, you got to know this in multiple choice. Great way to master the topic, but then you got to be able to apply it at the highest level task-based simulation. I want to go off on a tangent for a second about anyone who's still in school. I know we got people still in school. Do me a favor, please. Do me this favor. If you're not in a master's program, do not waste those 30 credit hours on nonsense. Please do not. Part of our onboarding practices, we want to give you career advice. Do you want to go audit, tax, advisory? Do you aspire maybe financial services, finance someday? We want to help you choose your credits wisely. And then we want to say, okay, based upon those classes and these parts of the exam, we will help you, every one of you individually. Isn't that a shock? We don't get you to sign up and then say, okay, good luck, here's the course. No. Individually, you are onboarded. Here's how to put together your study planner, and here's how you're going to set up your studies, and here's the electives we suggest you take, okay? So unbelievable attention to detail for every one of you. Remember I was talking to you before about the detailed explanatory answers? Link to text is a shortcut and weak. Everybody's got link to text. I'm not impressed because that wastes time to go back and forth to the text, especially when the textbook is not specifically addressing this set of facts and these particular answer choices. It's whack. You're wasting my time. I want a detailed explanatory answer that, number one, high level, what's the issue, what's the rule, and then how do I specifically apply it to this set of facts. Why is that right answer right? But just importantly, why are the wrong answers wrong? Tailored to this set of facts and these answer choices. You're not doing me a favor by linking to text. I'm sorry, I'm not impressed by 2002's technology, okay? And then every question has a things to remember, because look, at the end of the day, what is this question illustrating? That's why we go beyond the scope of the question, because I don't know what the hell they're gonna ask for amortization, the ending lease obligation, what the journal entry is, I don't know. So we cover it all. I mean, that's the name of the game, baby. Quinn, I won't steal your thunder with this. Go ahead, pal. I know this is your favorite.
Well, somebody had asked a really important question about what makes UWorld unique. I think they might have phrased it a little bit different, but what are the UWorld differences? And this is one of the keys. So we talked about quality instruction. Pete covered that. We talked about the quality answer responses. So if you want a detailed answer response, he covered that. You're going to find that consistent quality is a component that is a huge priority to us at UWorld. How does this all map to your individual strengths and your weaknesses, and how does it tell you when you're test ready? Well, let me introduce you to the SMART path. Ooh, where are you going?
I'm sorry. No, I got you back. Hold on.
All right, here we go. So SMART path is basically the coalescing of everything you're doing in the program, mapped out by chapter. It is detailing your progress on your score, and it's also detailing your progress by the number of questions. So there are the chapters, and the top level there, we're seeing the score. So in this particular investments in debt equity, my score is 73%. And if you see really closely over to the right, you'll see a little target there. And that little target is going to show me exactly where I'm tracking. So in the beginning, the one in the middle there, Pete, not the summary performance, but you'll see these little targets on each one. And as I approach those targets based upon my score and my readiness, you're seeing either the red, yellow, or green. Now, these targets have been established by the over 400,000 folks that have used our system and have passed the test the first time. I am sure that you're well aware that the national pass rate for this exam is 7 to 8 times. That is a heavy lift. That's a huge personal sacrifice. Our system, the key difference that I want you to walk away from today, among everything else that we discussed, is if you're able to turn these targets green, like the bottom one for derivatives, your pass rate statistically, historically, on our system would be 94%. Just imagine that. Okay, 94% pass rate. There you go. Not sure why we're on that slide. Let's go back. Here we go. So how do we help you get there? We track you. We let you know when you're test ready. We map out your individual scores based upon your strengths and weaknesses. And then we give you helpful tools like the study planner. Pete's all over the place today. Here we go. That allow you to detail our system. And in this case, we're taking a look at the FAR. And you can see over on the content, people always want to know how many hours, and I'm sure people talk about that in a second, but you'll see that you're literally taking down the 240 hours of all the material, and then you're breaking that down into a day by day, how many hours can you commit? And when we become a UWorld customer, we will advise you one-on-one. We'll talk about what areas you're working in, what your academic success was, what area, which courses you did well in, and which ones you might have struggled with. And we're always going to advise you to try to get to study segments of 4 hours because it's a 4-hour exam. This is also a great thing to commit to share with your manager, your mentor, but it is also adjustable. It allows you to accommodate the realities of work-life balance and change it on a day-by-day basis if you have to. So really, really helpful in sustaining the success of what is really one of the more challenging things. That is both a time management review strategy and a test taking strategy. So dynamic study planner, another key UWorld difference. So quality instruction, quality answer responses, the tools to help you get there, the smart path to let you know when you're ready to go. Now, here we go into sales mode, big time. Let's go forward.
Hold on one second, Quinn. I just want to mention, folks, another thing, if you're working full time and we are so happy that the firms are reaching out to us and really wanting to work with UWorld. It's been amazing. They have so many people who are up for manager who can't get promoted because multiple reasons. First, starting with you're doing well at the firm, you're a victim of your own success because the better you're doing at the firm, the less free time you have and the less time you have to study. So they want to promote these people to manager, and they've engaged in working with us to help remediate what's been the problem. Why are they failing with that other system? How can we put together a study plan that's going to work for them? But you know what the beauty of this study plan is? You could share this with your manager. And a lot of the firms we're working with now, they want it to be a collaborative effort to say, hey, you know what? We looked at your study plan, but you know what you got to do? This week here, you're going to be on an engagement. Let's reduce the hours here, but we're anticipating this week you're going to have more time. Let's increase the hours here. When you collaborate with your manager, you get that buy-in. You could see where the holes are going to be in your schedule to put together a plan that works for you and works for them because they want you to get promoted. Your billing rate goes up, and you know the pipeline issues with retention issues. They don't want to lose good people. So when you share this information, it benefits you and the firm.
Here's the whole package. We've got everything in here. There's a lot that we didn't cover, but if you'd like to learn more, we're happy to take you, your firm, your school, your university, all the way through a full-fledged demo. We do that all the time. Tremendous amounts of information up on our UWorld.com at accounting, CPA review. And today, just for today, for those of you that participated, we're offering a point of purchase as if you were one of our university or firm partners. So we know you're coming in as individuals, but we're offering the full elite course for you. until you pass with all the tools, includes live boot camps, unlimited access for $19.99. If you go to the next one here, Pete.
Oh, and I just want to mention, folks, this number could be further reduced. You contact Quinn, you get us in your firm or university, and you help us. You don't need to get the deal. We've got to prove to your firm, and you could help us in a sense that, hey, I attended this. I thought this was wonderful. And I'm sure you're going to have colleagues or friends that when they see the difference, they'll feel the same way. But if you help us partner at your university, at your firm, but just making the introduction to the decision makers so they can see who we are and what we are all about, you ain't going to pay the $19.99. And if you're already at a firm where we have a deal, you always get the lower price. So if it's at a university or a firm where we already have a direct bill or something else in place, talk to us. We'll let you know where we are with your firm or university. And if there's a better price, we'll always get you the lower price. I'm sorry, Quinn.
All right. So if you're a student, you're currently in an academic program and you want to join the UWorld team, hit that QR button that's on the left. That's designed specifically for you. If you are going to be a working professional, you got a job offer, you are at the firm, or you want to switch from whatever else you were using to UWorld, this code on the right is for you. Once you complete this, you'll get the limited time offer price that you see here today, and then you'll get a secondary email from me and one of my team members welcoming you on board and setting up your advising and counseling session. So just take a minute. Yeah, let's make sure they get a time there. And if you just think that this is great and you want to join the team and share and spread the word, we've got an opportunity for you to learn more information about becoming an ambassador. You could be a student, you could be at a firm, but if you just love the jam that Pete's bringing to the table and you're on a mission to help others succeed on the CPA, we're here to support you with a program called our Ambassador Program. So you can learn more. We'll be having information sessions that you gain access to by clicking this link and signing up.
Oh, wait a second. And look at the beauty. Earn access to a full course. At what price, Quinn?
That's complimentary if you're going to join the team.
$0. If it's free, it's for me. Let's go. And that's what I was saying, man. Make that introduction. You know, be an ambassador for us because you believe in the program. That's the most important thing. I don't want you doing anything you don't believe in. Sample everybody. Come back to us and you say, Pete, you're right. This is going to work for me. Then we want you as an ambassador. You believe it, you'll make other people believe it.
All right. If you enjoyed this one, join us again. We're going to be doing it again. Of course, this is a regular offering within our program that Pete talked about, but if you want to be one of the almost 2,000, I think over 2,000 registrants for this one, it is going to be, of course, Pete doesn't stay within the lines. He's passionate. And he's going to extend that time for you and bring value, unprecedented level of value.
I don't want you to make them think they can hop off at 12 Central Time. I want to make sure they're aware Pete's going to need the extra time. Also, Pete, requests for accounting for income taxes. So as you put together, you know, topics that you want on future free lecture series, you're getting requests for accounting for income taxes. Just want to throw that out there for you, Pete.
Megan, great point. And Quinn, I think there's a feedback link here that they can put that in. So if you guys have requests, and even beyond FAR, BAR, Reg, TCP, we're constantly revising these. So, you know, anything you might find valuable, let us know. But we can't do the whole course for free, because then I can't eat and then I'll be too skinny.
Any questions? You guys want to follow up? Anything? Feel free to contact me, Quinn Perkson at qperkson@uworld.com. That's QPERKSON at uworld.com. Thank you so much, Pete. Thank you, Megan. Thank you, Julie. Thank you to all the attendees. Thank you so much.
And thanks for going back to that slide. We've had a couple of inquiries about how to get this pricing. It's only going to be available through one of these QR codes. So please make sure to grab the screen grab of that, grab a screen grab of these QR codes so you can take advantage of it.
Yeah, and folks, thank you on behalf of myself, Megan, and all the other instructors at UWorld. I hope we're earning your business. I know this was free monetarily, but it certainly wasn't free in terms of your time. So I hope we use your time wisely. We look forward to working with you and help you accomplish your goals. And as they say in my hometown of Mobile, Alabama, everybody, who's better than us?
Nobody.
There you go. See you guys later. I'll meet you in the library. Let's go.